Welcome to Just Go Grind, a show all about building and investing in companies, featuring interviews with startup founders, investors, and operators, sharing the best insights into the world of entrepreneurship. I'm your host, Justin Gordon, and in this episode, we have Eric Shoykhet, founder and CEO of Atom Finance. As an institutional analyst at Blackstone and Governor's Lane, Eric had access to enterprise platforms like CapIQ and Bloomberg. He quickly identified the massive information gap between those platforms and what was readily available to retail investors via platforms like Yahoo Finance. Eric founded Atom Finance in 2018 to bridge the gap and provide the same market research resources traditionally available only to Wall Street professionals into the hands of any investor via a powerful, intuitive platform that works anywhere. Since starting in 2018, Atom Finance has raised more than $18 million in venture capital from the likes of Greycroft, General Catalyst, and others. In this episode, we go through how this company got started, what Eric's done to grow it since, and where he's looking to go in the future. As always, the show notes are at justgogrind.com/podcast, and you can support the show by leaving a rating and review over in Apple Podcasts. Without further ado, here is Eric Shoykhet, founder and CEO of Atom Finance. Eric, welcome to the show, man.
Thanks for having me.
Yeah, appreciate you taking the time and excited to talk about Atom Finance and the things you've done with this company in only for a few short years here. For people who aren't familiar, what are you doing with Atom Finance?
So we're building a best-in-class financial information and research platform that is built in kind of a modern product-centric way that is accessible to a larger audience than this sort of software and information has been kind of privy to that audience previously. It's kind of been more, premium content and information related to public markets has really been exclusively something that, institutional investors have traditionally had. And generally, it's only been accessible in very clunky and very expensive platforms. So our whole mission is to present that same level of quality content and data and sophisticated tools, but in a very easy and seamless way to use, and ultimately at a price point that is accessible.
Yeah, the pricing of these other tools it's kind of insane how expensive they are. And to that point, why did you decide to start this company, and how did you decide, like, I want to go after this, I want to actually pursue this? Mm-hmm. I'm curious.
So I've always been a super passionate public markets investor. It's something I've always loved to do. I think it's a privilege. And I think, private markets and VC investing to some extent is similar. I think it's a privilege to be able to get paid to, learn and to learn about businesses. And I think the great thing about public markets, which, is not necessarily the case in private markets, but ultimately there is a kind of reckoning, is that, there's always a scoreboard, right? And I don't think markets are necessarily, perfectly rational in the short term, but I think over medium to long periods of time, right? Ultimately, the market does generally do a good job of assessing business quality and business performance. And so I think it's a beautiful thing to be able to, take a view on a business, learn about a company, learn about an industry. And, if you're right and the market ultimately agrees with your assessment of that, you can profit from that. And I think that's super fun. And I've always been a passionate investor. And then I spent some time at Blackstone in the restructuring group there, and then went off to help launch a hedge fund that was spun out of Eden Park. Did that for a few years and covered a bunch of different sectors, and just got the itch to do something more operationally intensive, and didn't really actually know what I wanted to do when I left my fund. But this is just a space that I'm kind of addicted to and super deep in, and have always felt as a user of the products in the institutional space that there's really no need for some of those products to be priced at 10 or 30K a year. And obviously, I think even if they were more accessible, I think the way they're built in terms of, kind of the functionality and how complicated it is to do certain things would not really make them viable products for a kind of a larger audience, right? I don't think it's a kind of a something you would want as a product developer, that your product takes 3 months to learn how to use. I don't think that's something you should aim for. So, yeah. I think there's that dynamic. And then when I left, obviously was kind of using, I wasn't paying 10 or 30K a year out of my pocket. And so it was kind of left with, the various brokerage apps and things like Yahoo Finance and Google Finance, and just felt that, those were just underwhelming experiences and didn't solve for, I think, a level of sophistication and product quality that I thought was necessary for a certain subset of the retail investing market, but I think a certain subset that I felt would grow and kind of become larger as the retail investing space grew. And so set out to build a better platform that had that sort of same quality content, data, and tools that I was used to in the institutional space, but that did in a way where it was a product you could quickly learn how to use and get value out of, and obviously didn't price it in a way that would make it inaccessible.
With that as well, Eric, I mean, what were some of the hurdles you had to jump over to get this off the ground, to get like even version 1 of Atom Finance live? I'm curious.
Yeah, so the early stages of developing product obviously are always brutal, because you're starting from scratch. So from zero, I think the real challenge here is, well, there's two pieces. So obviously, building the front end UI is one thing, which for this sort of product is not trivial because there's so many different use cases and functionalities that you can build, and there's even for the same type of person, they're in the same job or the same type of investor, the things they care about could be very different, and their specific use cases could vary. So you have to have a good breadth of product to have a good suite of features that would give you kind of a large enough addressable audience. However, you have to make sure that you're doing that without making the product too complicated and too heavy, and that when a new user enters that product, they're not overwhelmed with like a bunch of different potential features, right? So there's that element. And then there's also the whole data and content ingestion and provider piece, which is pretty complicated in this space. There's a bunch of different data providers. They're pretty old school. Sometimes they're decently hard to integrate with. And, now we have over 10 data providers and content partners. But, when we started, we had to figure out kind of, okay, what are the core information sets and pieces that we really need to have on the platform? And let's go focus on building those relationships and get those deals signed initially, because that's highest priority. But from there, we've obviously grown and partnered with some great companies on the data and content side. But that piece takes a while, and you may want to move fast, but signing those deals just takes a while to build that ingestion infrastructure to kind of build out the platform. So that was really those were the two kind of key, I think, challenges in the beginning. But we were able to kind of just fight through that and really started working on the platform at the end of 2018. And kind of the web MVP was essentially built in the first 3 quarters of 2019.
To that point, in that process of figuring out, okay, you have to prioritize what this is going to look like initially because you're not going to have everything you want to have on it. What were some of those customer discovery, questions or calls or things you were kind of getting information around with that to decide on what the first versions was going to be?
Yeah, it's a great question. So, there's always 2 ways to, I think, go about building a product like this. One is to obviously go interview customers and say, hey, what are your pain points? What can we help build for you? That sort of workflow, which I think is super important. In this case, because I just know this space so well and I've used every product, I really just built for myself. So I was and I wasn't necessarily just building because obviously I'm a specific type of investor. The beauty of having done this for a while is I understand beyond just myself, like different types of investors, and generally speaking, what different segments of the investing world, what those sorts of users would want. And so I was just essentially product czar and was like, look, this is what we need to build for the MVP to have something that we could show people, that we could get initial users from, get initial traction, raise initial capital. And so that was I was kind of PMing that, especially, in the first half of 2019.
Raising initial capital, you just mentioned there. How did that fundraising process go for you initially? I didn't. You're first-time founder here as well, so I'm curious as how that went for you, Eric.
Yeah, it's super interesting because I've always been, I hadn't invested in private markets, but I've always been kind of on the other end of the spectrum, being the annoying, hedge fund analyst asking, way older public management teams like questions about their performance, and probably they're not always super happy to have to answer some 28-year-old who thinks he's hot shit. But so I've been on the other side. So I think the one advantage of that is I understand very well how investors think. I think I'm able to kind of frame kind of a larger investment opportunity in a lens that they would understand. I think the other thing is that this is just a great space, right? In software, the financial data space is massive. There's a lot of dollars floating around to capture. And so I think because of that, it is a good space to think about disrupting and capturing value in. But look, it's always hard as a first-time founder. You get the traditional questions. Well, I'm sure you understand the space, and I'm sure you know what a good product may look like. But like, how do I know you can actually build one? How do I know you can build a team? How do I know you can execute? And I think as a first-time founder, you don't necessarily have good answers to those questions because there's nothing necessarily you can point to other than trust me, this is why I'm doing this. This is why I'm passionate about the space. This is why I think I can build something. And that's it. You have to convince people. And so I think, that, especially being a first-time founder, that is a much bigger challenge in terms of raising capital.
And you raise again, I mean, just to take it a little bit far on the raising capital side of things, obviously raising your initial funding is one thing, but also raising the Series A. What lessons did you take into that as you've raised additional capital compared to maybe the early days of raising capital for Atom Finance?
Yeah, so obviously the very early seed rounds are usually like, okay, you have some proof of concept, or you have a general idea, or you have a space you want to go after, et cetera. I think really for incremental like for future rounds after that, it's really about setting out what the key objectives are going to be for the company, and then like hitting them. Or if you don't hit them and you pivot or you change something, like having a very good and clear explanation for why that happens. So I think it's about, and I think you see this in, I think there's a great lesson here for public markets. So you often you'll get a lot of people who will pitch a stock and oh, this stock trades at this valuation and it's a discount to the similar peer companies, right? And then you'll look into it and it'll always be like, well, this one has a way shittier management team, right? And so I think the bottom line is public markets reward consistent execution, even if you have two assets that are kind of similar in terms of quality. And the reason is that there's people like consistency, right? If you think about people like consistent returns, people like consistent performance, and there's a lot of reasons why that's important, especially if you get an adverse external shock. And I think it's the same thing with running a company. Investors reward clear and consistent execution, and they reward execution against the plan. And so I think raising incremental rounds of capital, even as an early stage company, is really about doing that. I think it's about saying, hey, we just raised this round of financing. This is how we're going to deploy this capital. These are the high ROI things we're going to do with it. And this is our timeline for doing that. And then you check in with them consistently over time as you're doing that. And I think generally speaking, if you have a good product and you're in a solid space and you're not in a catastrophic fundraising environment, if you do that and you consistently hit kind of the explained plan of action that you gave previously, I think you'll be able to raise capital.
One thing I keep thinking of as we're talking here is just thinking about the space at the time you decided to go after this. You didn't really see competitors necessarily in the space, in the market. Why do you think that was? It's only a few years ago.
Yeah, it's an interesting question. I got asked that a lot when we were raising money. Why hasn't someone done this? Blah blah. And the answer is there have been people who've tried smaller niche things that probably haven't heard of. I think what really happens is that if you take a step back in this industry, right? So you look at the brokerage business. The brokerage business started out where you would call someone on the phone, right, and they would go put in a trade for you, right. And then they would come back to you 4 hours later and be like, okay, I filled your 10 shares of Microsoft at 38 and 1/3 or whatever. Right? When these trade in fractions. And so then those companies obviously discovered the internet, and then are like, okay, why don't we let people click buy sell on a website, right? So that was V2, and that kind of evolved, and then there was obviously phones, and so people were like, okay, we need to have apps, etc. But those companies have always been financial businesses, right? Like the brokerage businesses are, the way they make money is, you can actually just look at how they make money. Right, they make money from interest on the float, right? So the assets that are held in those brokerage accounts, they make money from trading commissions, and they make money now, or some of them do, from selling order flow, right, to hedge funds. So those are the revenue drivers, and none of those are software revenue streams, right? So they've always built the business around gathering of assets and getting people to trade. That's how they've made money. The challenge with that is that they are brokerage businesses; they're not software, right? So they're not experts in building, great software experiences and they don't know how to build, a user-centric product to some extent. That's not their core business. And so that's kind of been one end of the spectrum. And then on the other end, you have things like Yahoo Finance, which cropped up and was good. And then, they did ads and blah, blah, blah. And the ownership is turned over. And like many Yahoo assets, unfortunate things have happened to once great products. And then you've had a few other, things that were really specific point to point, like vertical solutions that, I want to look up like what a hedge fund owns, or I want to like look up SEC filings. So like that have looked at very specific use cases and have built websites or tools to do that. So that was generally the landscape. And I don't think anyone came along and really said, hey, I want to raise capital to build really just a more modern version of like, people use Bloomberg as an example, but I think it's not just really Bloomberg. It's like a blend of, Bloomberg meets like CapIQ, FactSet, some of these other, it's kind of a blended solution where you can't just have, some of those, for people who know the space, like some of those solutions are just like financials. So you go to them, you look up a company and there's just financials.
Yeah.
You need something that's like one use case, right? But you need something that lets you do market monitoring, which means you have content and quotes and charting and things like that. It lets you do financial analysis. It lets you, compare companies, things like that. So it needs to be a more encompassing solution. And the only thing really that existed that had kind of quality market monitoring, quality content, the available data and tools was really Bloomberg. And then some of the other, call it $10,000 a year solutions like CapIQ and FactSet, they don't have content, for example. So they're missing like key pieces that for a lot of retail investors, like those would be issues, right? If you had a platform where it was just financial information, there's no news at all, right? That's a huge missing use case. So there was this bifurcated landscape, and kind of we came along and said, hey, we think we can actually just build from the ground up a full kind of robust platform. There's a real gap in the market here between these brokerage platforms, the Yahoo Finances of the world, and some of these institutional legacy solutions.
Seeing this opportunity, Eric, who did you decide to work with on actually building this out?
So in the early days, we just kind of hired some contract engineers that I had through my network to start building and iterating on the initial MVP. So, I think the best way to get going is often to just get going. So, you just hire people and start building a very basic version of the product, just to have something candidly even to show, investors and potential users, things like that, because, it's hard often that's like a just useful tool to have in order to raise initial capital.
Yeah, it is so difficult. You need to have something, especially in this type of thing, just to prove out you can actually build a product, and then obviously there's more that the team develops along the way, and a lot goes into that. One thing that we haven't discussed yet is getting these users. How have you gotten users for Atom Finance? I mean, how's that evolved over the last couple of years? I'm curious about that too.
Well, initially it was really just kind of sending out to people I knew in like the hedge fund space and investment world, and some blogs and like things like that I just knew as a public markets investor and user of a lot of other products that there's this finance group listserv, and it was really things like that to get the initial users. And then from there, kind of word of mouth took off, and people started to enjoy the product, and some of that came also as we made the product more robust. Like if you go back, I mean, there's nobody who can see this, but like maybe we have screenshots somewhere, but the initial product was like pretty basic, right? Because this is sort of product that takes a while to build up and improve. And, it's really hard to I don't believe in going into a back room and building for 3 years and then showing up and saying, hey, look at my amazing product, which no user has ever seen or commented on. Right? I don't think that's a good way to go about building something. So I think you get what you think an MVP is out the door. You expose it to users, you get feedback, and you iterate quickly and ship quickly. And so that's what we did. And obviously, as a function of that, the product has, I think, gotten significantly more robust and better over the last 2 years. And obviously, we built a mobile product and launched that as well. So, I think from that experience of the product getting better, we actually had a lot of early users who saw the early version of the product, maybe said, oh, this is too basic for my needs, or, it'd be great to have all these other things. I'll check back and kind of evolved with us as we've made the product better, and therefore have become somewhat evangelists for the product.
Yeah, and then today, with that as well, as obviously the product has evolved, then today, what does that look like? You're obviously not just messaging your friends necessarily in the industry to grow Atom Finance now. I'm curious as to maybe what that kind of looks like today in terms of the strategy behind growing the product.
Yeah, now we have a full growth team, and we're pretty focused on traditional digital channels, but as well as especially in the finance space, there's a lot of like affiliate partners that we have that whether it's wealth advice or things like that are really relevant to us. So that's kind of been the focus. We um, are also very cognizant of getting the right type of user, if that makes sense. There's a large space out there of retail investors and also folks who use Atom in the context of a work environment. And, we think it's a large addressable audience, but certainly there are segments of the retail market that we, really don't care about. And there's certain types of users who, we aren't as focused on, right? So, if someone's trying to just, throw 5K into a bunch of call options and kind of gamble, that's not really an ideal user for us. We're more focused on people who want to like build wealth, build assets, and even if they're newer investors, they're looking to become more sophisticated over time. And then as well as that, we have folks who work at Fortune 500 companies, folks who work at hedge funds, folks who work in PE investment banking who use Atom, whether on web or on mobile, as part of various workflows and in their day job.
One thing I'm really curious about, because seeing what was on the market already and having, last year I graduated with my MBA in 2020, and I've seen CapIQ, I saw Bloomberg, all these different tools, and knowing how expensive they are. How did you think about pricing and getting to the price you have today? I'd be really curious to hear more about that.
Yeah, it's a super interesting question. I think so. The space historically has had this view, and this is actually symptomatic of just the way costs are passed. So traditionally, I think the space has basically said, "What's the maximum we can charge for this service?" And let's take 5% price increase every year. And the reason that worked for a while is that in a lot of cases, the fees for these platforms are actually passed on to LPs, right? Or end customers, right? So in investment banking, as an example, frequently the pro rata CapIQ, spend for the month of the deal that it's live is actually expense to the client, right? If you look at hedge fund lands or mutual fund lands or whatever it is, like those fees are bundled as research costs and expense to the limited partners, right? So in a lot of cases, people don't really give a shit if these things cost a lot of money or the prices go up, right? Which is obviously like a really, really bad incentive structure and has allowed, I think, prices to get out of whack. So that's changing actually, right? Just because like the number of hedge funds is shrinking, it's in decline, banks have cut seats, blah, blah, blah. So there is actually finally some like pricing pressure, I think, on some of these platforms. But when you have a situation where you have such a large kind of pricing headroom, there's a bunch of ways, you could price kind of a little bit below or what have you. Our view has always been, look, we want to build a great product. We think if we build a great product, people will use it and get addicted to it. It's a sticky sort of solution. And we want to charge a price that initially people are like, okay, this is really accessible. And like, they just get over the hump and get used to paying for it. And look, over time, we'll add more functionality. We have different types of users with different ability and willingness to pay, depending on certain features, depending on whether they use it for work or not. And so you'll see more kind of, not that prices will necessarily take up price dramatically, but you'll see more sophistication with our pricing in terms of aligning pricing for different types of features that have different sorts of, use cases. So that's what we're going to do. But I think, initially our view was always, and the product was free actually before we charged them. It was free for like a year.
Yeah.
And our view there was, let's build a great product. Let's get it out there. Let's make it super accessible. We can introduce pricing later as we continue to learn about our product and our user base.
Yeah, and pricing always evolves. I was just talking this morning with the founder of ChargeBee, raised like $105 million, and they've obviously built a really big business, but it took 9 years to get to this point. And the pricing from them has shifted so dramatically over time, and they've tested different things out. And to your point of like the value providing and how you can pay, how someone will pay for that, and what the differences will be, and how you structure the tiers of pricing potentially. And it's a fascinating world to figure out all of that. And a lot goes into that, but ultimately it's like testing as well. It's really a big part of it.
And you just can't it's one of those things where like, you just don't know until it's live, until you spend a lot of time with users and you get more data. And so it has to necessarily evolve because you can never, it's not possible to go to market initially with what will ultimately be your final goal for pricing, because and frankly just because users need to evolve with that as well, and it could be that that sophisticated pricing with tiers and different costs for different features. That's a end goal that you want to get to, but it's just too complicated for something to launch with.
With your experience in your previous role, and now obviously being an entrepreneur with Item Finance, how has your previous role influence your decision-making process or how you think about building this company?
Yeah, it's a great question. I actually think it might be more of the reverse, which is if I ever go back to, which I probably will at some point, like public markets or just investing in general, I think I've become a much, much better and more thoughtful investor having been an operator. But I'll say, the good thing about being an investor is that you learn to quickly kind of dive into a space or field, do research, and like come to a conclusion. And so I think generally speaking, I have a decent understanding of a lot of different areas of building a business and I'm quickly able to learn and adapt. And so I think that versatility makes you, gives you some advantage as an operator. I think the one challenge that people will have transitioning from an investing role to an operating role, if they haven't done it before, is you need to shift from a passive observer mentality to an active get shit done mentality. I think that's really hard because it's really easy to sit there and like, okay, I'm gonna ask questions, I'm gonna evaluate a space, and you can do that forever, right? But that ultimately doesn't build the business, right? You need to actually get things done. You need to hire people. You need to close deals. You need to build a product. And I think transitioning that mentality from the passive orientation to the active orientation is challenging. That's something you have to work through. I think the good thing is once you get through that initial pain, you have a real team and you've raised real capital. I do think, having been an investor does teach you something about how you should spend your time as a CEO in terms of thinking about, allocating capital, hiring, ROI of decisions. I think that framework is super useful, but it's definitely not probably as useful in the very early stages. I'd say that's more of like a Series B-ish or later type of advantage that you'll have as a investor. And I think on the reverse, I think once you go from operating to investing, I think you just become so much more thoughtful about the types of questions you would ask a management team. And I think a simple way of defining it would be I would now ask very much less questions about actually like financial performance or things like that, and much more about culture, hiring practices, things like that. Because I think in the end of the day, a lot of times those financials that investors are always obsessed with are actually quite a lagging indicator for what's actually happening in the business. I think there's better ways to get at what's actually going on. And I think having been an operator, you'll tend to understand much better.
Yeah, and that's actually one of the next things I wanted to dive into was the hiring culture side of it, because I think for every CEO, I mean that's you're fundraising, you're hiring and firing, you're doing sales essentially in some capacity. So on the hiring and culture side of things, with it being your first company and really you're saying you've learned a bit in that, what's been helpful that you've learned along the way in the hiring kind of culture side of things?
Yeah, I think in the beginning, you just don't know what you're looking for, right? It's kind of like, I always say a joke that like hiring and dating are like the same thing. They're pretty similar. And it's always like in the beginning, like you just have no idea. You think you know what you're looking for, but you really have no idea. Because then you meet with a bunch of people and then you're like, oh, okay, like, no, this is not good. I thought I needed this, but I don't actually need this. I need that. So that's like the first, in the beginning, especially for new roles. Like we always go through this pain. Like we just hired for a new type of function recently. Like it's the classic, you waste a month and a half trying to figure out what you actually need and filling it out. And then eventually you start to understand what the different elements of that role might be. And then you better define what the ideal archetype candidate is for that role. And so in the beginning, when you've never hired before, you really don't understand that at all. So whether, especially like, engineering hiring, let's take that as an example. I never hired an engineer. In fact, I had never managed anyone because at my funds, everyone's they're just an analyst. And so I've never managed another person, right? So that's like step one is understanding how to, that whole hiring someone, managing them, that was all totally new to me because it's not something I had done, in my previous life. So I think it's really about understanding how to build a good hiring process and funnel. I think with respect to engineering hiring, it's actually something that is somewhat, I don't want to say mechanical, but it's very solvable in the sense that you can, it's really like engineering hiring is really about like numbers and funnel and like there is a way to make it kind of a machine. I think we've done a good job of that now at this point at Adam. But in the beginning, it's just really hard because you don't know what type of engineer you want. You don't know what type of archetype. And then I think the second point is, the first, everyone says this, but I'll double down on it. The early people you hire at your company are the most important, right? They set the culture, they set the tone. And so there is some fear of getting that wrong. But ultimately, I think you need people who are both like understanding of what they need to do and like have a clear cut role, but can be very good generalists and just can have that get shit done mentality. Because at a very early stage company, right, that's what you need, right? So you can't have people who are like, oh, I was hired to this exact thing, and then they need to do something else for, because that's what's necessary, and then they don't want to do that. So you need people who are very sharp, very versatile, have a get shit done mentality, and are willing to just do what is necessary to get the business to the next level.
Yeah, that's so important, the hiring side of it. And if you get that wrong, it's going to be a pain for quite some time within that as well. Today, and this is 2021 now, looking at where Adam is at this point, what are your biggest challenges, or what are the things that keep you up at night now?
I still think hiring. I think getting the right people is always super challenging. I think luckily we've now built more of a brand name, and we've raised more money, so it's easier to get people to join. But I don't think that ever, like, hiring good people ever stops. And it's the classic that, again, another phrase that people use, but it's true. But if you hire great people, they tend to bring on board incremental great people, and if you don't and you hire poorly, that tends to lead to catastrophe, and those people tend to hire even worse people. So you want to make sure that you're hiring only A+ players, and I think compensating people well. And making sure that they have a large equity ownership in the business. And that's always been, you asked earlier, my philosophy. I've studied, I think if you want a good case study, and they've maybe stumbled a little bit recently, but I think the 3G guys in Brazil are super interesting. And they have a philosophy of compensating people super aggressively and promoting people very young, and giving them pretty little cash comp relative to their level of role, but they're pretty high in terms of aggressive performance-oriented equity compensation that maybe has gotten them into trouble in some of these businesses recently. But I believe fundamentally in that philosophy of performance-oriented, heavy equity compensation. And, those are the kind of people we want to hire, because we want people who want to win and want to build a great company and want to profit and be, rewarded, via ownership in the business as the business does well. And so I think figuring out what you want your comp philosophy to be in your company is like a really important thing to establish early on. So I still think hiring great people, making sure that the team is structured properly, and that I'm doing a good job empowering people to do their job well and give them the resources necessary to succeed is like the most important thing. I think beyond that, it's really just execution. We're not in a space where we're solving the technical problem of like getting a rocket to Mars or something like that, right? There's not necessarily technological risk that we're taking. The risk we're taking really is product execution risk, and us, right? Like the team risk, if you're thinking about it from an investor standpoint. And so that doesn't bother me, because I have high conviction on myself and our team and our ability to execute and build great products. And I'm high conviction that this is an attractive space with weak products and a lot of ability to capture value. And so really it's about us amassing the resources and the team necessary to execute in this environment.
One aspect that we've talked about a little bit, you mentioned having those data partnerships or data providers early on. It was just a few, and having obviously more at this point now. I'd love to hear more about the product today, just in terms of, okay, if someone's looking at why would I use Atom Finance versus these other platforms available, what would you tell them? What's the pitch around that in terms of the actual product and what they're going to get and what this is going to look like and feel like for them?
My first answer would be it's better. I'm just kidding. No, I'd say we've built a easy to use, robust platform that, with respect to investing and researching public markets, is unrivaled for anything else out there, and have married, I think, ease of use with depth of the research capability. And so I think we've done a good job of that, and I don't think there's another platform in this space that does that. And I think even the institutional platforms, for many use cases that we have, we actually solve the actual problem much better. You may have, 38 different combinations that you can graph things or pull data in one of those institutional platforms. But for 80% or 90% of the use case that you really care about, I think actually we do a much better job.
With being a first-time founder, what's been the most helpful people, resources, et cetera, for you that's been helpful as you've grown the business the last few years?
I think other operators and other founders are always going to be the most, as a first-time founder, always the most useful people in terms of helping you navigate specific challenges, whether it's hiring or fundraising and getting advice. So I think people who were operators and founders and are now seed or early stage investors or angels, I think is actually, those are the kinds of people you want in your corner. And I think makes sense to take capital from, just because, and even if the checks are small, just because they tend to be the most useful people to lean on if you have questions because they've been there.
What does that communication look like with you and your investors in terms of how that typically goes for other founders who may be wondering?
I'm pretty focused, generally speaking, on, internally, let's put it that way. So I communicate with our investors, generally speaking, when I, have a request or, we want to catch up. But I try to, really focus on the company and not necessarily on managing our investor base. And I think our investors, trust me to, and trust the company to execute and aren't expecting, constant hand-holding and updates. So, I'd say we're more probably with our investors a bit more hands-off maybe, and a little less active maybe than some other companies. But, generally speaking, if there's, an investor I know who has, connection or something that, relationship or, has a suggestion on hiring or something like that, is relevant, then, obviously, we ping them aggressively and we leverage our investor base. But generally speaking, I like to turn the focus inward, and I'm really a big believer in no one's going to build your business for you.
Yeah.
I think people who think that they're going to get some fancy investor on board and that's going to help them build a company are they're very wrong.
Yeah.
So ultimately, I think it's super important to have a great investor base and to be well capitalized. And I think leveraging your investors in the right way, whether that's for a specific intro or a candidate referral, things like that, that's great. And that's how you should use them. But I don't think anyone should expect that, specific investors can help you build your product or, build your business.
Yeah, that's a small percentage of what they're going to be useful for. Is mostly just you and your team building the company, and that's kind of how it goes. I'm curious as to, with every founder, and especially when you're a venture-backed founder, high growth companies, how do you charge? How do you kind of make sure you're performing your best each day, Eric?
Great question. I think Buffett has said this a bunch of times. He always jokes if you look at his calendar, it's like blank. Not that my calendar is blank, but I think focusing on what really matters. There's very few decisions that you actually need to make a week, and there's very few things that are actually important, especially as a CEO, that you really need to do, right? If you close one good hire in a week, or you have a good investor conversation, or you have a really good sales call or something like that, those could be super, super high impact conversations that maybe only take 20 or 30 minutes, right? And so I think it's focusing on the high ROI time you spend and those conversations that really matter, and not getting bogged down with all the minutia of daily team meetings or a lot of the nonsense. I think most people would probably cut their, the number of things in the calendar 70, 80% and essentially have no impact, because I think generally most meetings are a huge waste of time. And so I think it's really about focusing, especially as a CEO. I think you really need to focus your attention on the high impact decisions and high impact conversations that you need to have. And some people really it's a 2-part thing, right? Obviously, one, you have to identify what those, what is high impact and what's low impact. Forget the low impact stuff, and then really focus on executing well on the high impact things. And if you do that, you'll be less stressed on just bouncing between Zoom call, every 30 minutes. You have 10 Zoom calls a day. That's not a sustainable lifestyle. You do not want to be doing that. You want to have several high impact conversations or tasks that you need to do, and focus on that. I think if you do that, you will just generally be happier and more relaxed.
How do you process that, or how do you prioritize those things? Or do you have a process in place for separating high impact, low impact? Do you look at that on a day-to-day basis, a week-to-week basis? I'm just curious on how you've kind of gone about that, at least personally.
Yeah, it used to be, especially, and I think again it changes as the company evolves. Earlier on, I was very in the weeds on everything, right? I had tons of meetings, little product things like that. As obviously the company evolves, I think it's important for you to abstract yourself a little bit and to empower the people you've hired to do their job, right? And to not micromanage. So I think you really need to like that. For me, that's actually a challenge because I'm a perfectionist and like I'm super, I'm always in the weeds on everything. I'm obsessed with our product and, I use it super heavily. So I am our biggest critic and I'm always in the weeds on product things. But, that's been a challenge for me. And I always am like trying to be cognizant of making sure I'm not micromanaging and I'm not too much in the weeds and kind of abstracting myself. So I do focus on that. And I would say, look, with respect to what's important, I think each company and each founder is, unique, but I think it's pretty obvious for the person to see what it is. For me, it's always, very simple, which is really hiring combos and, big customer conversations. We're pretty focused now on some B2B offerings that we've built out, and we're having, partnership conversations. So those sorts of conversations are obviously high impact and are very important. And then, fundraising conversations are always important. It's important to maintain a good cadence with investors. You shouldn't let it dominate your schedule and shouldn't be the only thing you're doing. But, those are important, especially with folks you've built a rapport with and have a relationship with. So those are like the three really, I think those are always the three core areas.
Have there been any particular books that have been impactful for you, whether it be personal or professional?
In terms of founding a company, I would say there is a good, I'm forgetting the name, but the 3G book is actually really good. It kind of walks through some of their early deals and just kind of how they think about things. So I would say that with respect to building a company is a good read.
And just one of the final questions I have is just what are kind of the next steps or big vision you have for Atom Finance moving forward?
Our singular goal is to expose as much institutional quality tools and content to as large an audience as possible. And so that's, taken so far, been done, I should say, via, our own platform. We are going to be partnering with other financial institutions and integrating some of our capabilities into their platforms to kind of double down on that mission and to accelerate our distribution. So that is kind of the next stage of Atom is really leveraging Atom's capabilities in the context of other platforms. And we're super excited about that because it's going to let us get distribution scale beyond, what we could do as just ourselves, and in terms of just growing our, own user base. So very excited about that and very excited about the ability to help some companies who maybe aren't as deep on the space. Maybe they're a neobank, maybe they're a legacy kind of just traditional bank, and they're looking to, differentiate in the self-directed investment and retail investing space and to provide a better, more sophisticated software experience to the users. So super excited about partnering with those companies to help them, better satisfy their user base.
Eric, where can people go to learn more about Atom Finance and connect with you as well?
They can go on our website, which is atom.finance. If they want to just learn more about the company, obviously encourage them to, there's an app, so you can download the app on the App Store or sign up on web. There's a web platform as well. And if anyone wants to ping me, they can DM me on LinkedIn or email me at eric@atom.finance.
Awesome. Perfect. Thank you so much for taking the time to come on the show today, Eric.
Of course. Thanks for having me.
Thank you so much for listening to this episode of Just Go Grind. If you want to follow along on the socials for all things Just Go Grind and with me as well, you can find Just Go Grind on Instagram and Twitter at Just Go Grind. You can find me on Twitter at JustinGordon212. Find me on Instagram, JustinGordon8. Thank you so much for listening. Have a great day.